Hello, everyone. Thanks for tuning in and watching another Horizon podcast episode. I had a great call again with Talion, and this time we had our last look at US inflation for 2023 with the December CPI report coming in, and it was really some fireworks left and right. Bonds did go on a roller coaster. The USD was going up and down all the way as well. On the side, we also covered some possible effects of QT taper that is thrown around a bit by FOMC board members, but just have a look yourself. There is a couple things to cover today. Today was, or is Thursday, the 11th January 2024, and we had first CPI reading, US CPI reading of the year. Got the December number from 2023, the last one, and it was certainly some head scratching out of it and into it, and it was quite interesting. Same time we got the jobless claims, the weekly ones, and we also had some bond auctions this week. 3-year, 10-year and 30-year today. We also got some Fed speak that we want to cover today, which is going to be quite interesting because there is some development on the QT front. So that is probably very interesting to keep an eye on. First, let's just start with the numbers we got today. CPI front, we got 3.4% year over year on the headline, 0.3% month over month on the headline, 3.9% year over year on the core, and 0.3 month over month on the core. You gotta say, that is sort of in line a little bit on the headlines.
And Adam was saying that the concentration is coming from health insurance, auto insurance, and rent.
Yeah, I posted the table, the full table in Discord and on the Telegram group as well. You can see it, everything there. There is a big number of that is coming from that. You gotta say though, probably you gotta add to it that 0.3 month over month is a bit more than what the target should be on the Fed and all the other central banks, right? That's not 2%.
Yeah. That's 3.5 to 4% year-over-year inflation.
Yes, exactly, in that range. So that is way too high still for the target, which should be a bit concerning in my opinion, even though if a big chunk is probably not sticky inflation or accounted for something that should not be sticky, right? But still it's not coming down. So that should be at least put a hold onto the pivot point talk from the Fed. But let's get to that a bit later. Let's first check the jobless claims data, because that is something many been watching as well today, besides the CPI data. Many been expecting a rise again in jobless claims and also in the continuing claims. But let's have a look. We got 202k on the jobless claims and we got 1.834 million on the continuing claims, which is both down quite a bit from last week. And it's just falling, right? It's just not rising. The labor market doesn't look like it's loosening up quite a bit. And that is also a bit in contrast with last week's big dip in ISM employment index. Yes, so that is quite a bit of a head scratcher as well.
This is a repeat of end of 2022.
Yeah, we said it already today, right? So if we look back just 1 year, it's been the exact same, right? End of 2022, end of 2022, everybody was like, okay, this is it. Data is finally falling, the labor market is loosening up. We are going into the recession in 2023, right? Everybody was thinking that.
Yeah.
And then suddenly, early 2023, late 2022.
The same deceptive ISM services PMI that solidified, the crystallized idea last time, exactly like last time.
Yeah. So everybody was like, okay, this is it. And then suddenly the whole thing picked up again in December 2022 and then early 2023. The job market tightened up again. Weekly claims been down quite a bit in early 2023. Continuing claims as well. The whole thing just accelerated again, right? And it somewhat looks like it's the same right now, right?
Yeah. This feels like a repeat.
It looks like there is some sort of seasonality into it. If you ask me, it's sort of like a pattern that is currently coming up, probably. But maybe it's just too early to tell, right?
Yeah, maybe. I mean, at some point it should weaken. So maybe this time the other side of the data is wrong. But we will see it only after some time.
Yeah, but one thing I'm really concerned about, well, not concerned, but I'm really baffled is, bamboozled. I really gotta say the word bamboozled. I got bamboozled today by the bond market, because that is quite interesting. So what we're looking here is the 2-year US yields on the bonds, right? And as you can see
it's
here,
just happening on the front. To note,
it's like, so crazy.
This is happening on the front end, just the front end.
Yeah, but that's
30-year is not doing that.
Well, let's just look at it, okay? So we have, sideways trading into the numbers, and numbers kicking in really hot, right? It's like, it's not some weak numbers or something, and it's okay. It's spiking up.
Surprise all around. It's a hot surprise all around.
So it's spiking up. That is as expected, right? The spike is expected because it's hot numbers. Of course, the yields are gonna rise, right? I mean, Fed cut. We're gonna have to say that for the March meeting, that is the next meeting after the January meeting. But the March meeting is what is everybody watching for, the first possible cuts, right? And the chance for a cut in March was at 65% before the CPI hits today, and it was hot, so yields have been going up. The strange thing is, nothing really happened on the expectations of a Fed cut after the CPI. So what happened? We crashed right down again, and the odd thing is, we kept on going quite a bit, and we are really above 65% chance now for a cut in March, which just doesn't make any sense in my opinion.
Dude, I think
so
I don't understand this movement exactly. Like,
I don't understand it either.
Maybe this is what Adam was writing. Maybe this is this is not rate pricing. This is just front end safety bid due to today's geopolitical headlines about bombs in the Middle East. I don't quite buy that, but otherwise, nothing makes sense. I mean, even the timing doesn't make sense. It didn't happen after market open or something. No, bonds were selling during initial hours of the RTH open. But after this UK cabinet meeting about this bombing stuff started coming into wires, some sort of bid came into the front end.
That was just later, though. That was really, really later. So I don't know. Well, as you can see here, it just opened the 30-year bond yields now. As you can see, we have sort of the same pattern, but it's just, the spike up first, and then a little bit sideways, and then the bit to the downside. But that is just not that
still positive on the day.
Yeah.
Still positive before the CPI comparatively.
Yeah, exactly.
So we have 10 basis points of steepening on 230s.
Yeah. I can put it up here. How do I have it? We can put it here. Yes. Now I can see it. Now I just gotta move it to a line chart, and then you can really clearly see it. That there is, or there was, a really sizable bit afterwards. Now, if you go to the 15-minute chart, maybe you can see it even more clear. So both been spiking up, as you can see here, 2-year up here in purple, and the 30-year up here in, down here in blue. So there was the spike initially on both, but then really the bid on the 2-year kicked in, and yields been dropping quite a bit, whereas the 30-year is still somewhat holding up. Now there is quite a bit of steepening on the curve for the short end, and I just don't understand it. Really, it doesn't make any sense.
On the day when there was the steepening came after supply too, right? After 30-year auction? Most of it came after supply.
Let me see. Currently, was it 1900? Yeah, it sort of came after supply. Yeah, we had a 30-year bond auction today.
Yeah, that was
which was solid.
2.5 hours ago.
Yeah, it was right here on my cursor, 1900, right at this point.
Yeah.
I can mark it with a vertical line. That, so it's more clear. Right there. That was the point when it came in.
Suspiciously located. So maybe people were waiting to buy bonds for supply to go away, but they bought the front end more.
But it doesn't make any
peculiar.
sense in my opinion. I
It
mean,
doesn't make any sense.
once bottoming out at the auction and then buying up a bit, that, yes, that makes sense. That makes a lot of sense. But why the strange bit in the short end, right?
Yeah, we don't get it. Moving on. It
Yeah,
was weird. I don't get it. You don't get it.
It was just weird, but we have to take it as it is. One thing that is sort of bamboozling me as well is the dollar, and we have to talk about it because it's so strange again. So as you can see, as it's expected, right, Dixie is up quite a bit on the data. It was just hot on every front. So the dollar is spitting up with yields, right? That makes sense.
Yeah.
But then it's just not following through. And I was already writing like at this point right there. It's doing it again, right? It's just doing it again. And it did. It's just, topping out and then falling for no reason, along with bonds, with the bond yields. It's horrible. If you're a dollar bull, it's just horrible. But it is what it is. You're gonna have to take it. Yeah, looking at the bigger picture here on the dollar and the Dixie, we're still sort of in the range trading for the new year. So this was end of last year, really late in December. This was early this year, so sort of back up. And since then, since early this year, we're just trading in a sort of tight range of around, that's 80 pips up and down.
I mean, Lagarde was declaring victory like maybe a couple of 10, 20 minutes ago. So maybe next ECB meeting we will get a proper dollar bid versus the euro.
Yeah, versus the
maybe
euro.
Maybe they will finally turn some sort of dovish.
Well, you're gonna say if we look at some charts like the dollar yen, it's still going, right? It's still gaining. We're up, or we got a new high today at 146.4. We're really just going, but that is really more to the yen weakness than to the dollar strength. Some point we wanted to cover today is the QT taper talk as well, because that is something that came up this week, and I think you can talk a bit better about that than I can.
Yeah, the first hints came with the last. I mean, I think Powell said that they discussed some during his press conference after his last FOMC meeting, and when we got the minutes for that meeting, we read in them that the Fed members did actually talk about their balance sheet policy. Then last weekend, Saturday, Sunday, something, Logan, I believe was her name. She was up saying, "Oh, we maybe should change QT when reverse repo gets low, not when it drains completely. When the reverse repo usage gets low, they maybe should consider changing the balance sheet policy." After that, Bank of America came out saying, it was early this week, that the Fed is going to taper QT, which means reduce the quantity of asset runoff from their balance sheet by 15 billion for treasuries and some other number. I think right now there's 65 billion treasuries and the rest is MBS, close to 100 billion per month. So that is going to get reduced maybe by 20 billion to 80 billion, something like that. I think that was the Bank of America call. Whatever.
So roughly 20% lower.
The basics is the Fed is already starting to think about tapering QT. And I think it makes sense. They don't have to cut QT to zero, from 100 to zero. They can taper QT from 100 to 80 and let still QT run. And like I was saying last time, just getting reverse repo to zero is not going to be enough of a QT in their mind. There's another excess trillion or so in excess reserves, and maybe there's other liquidity between the plus 5 basis points of the reverse repo facility and plus 15 basis points of the reserve facility, reserve pay interest payments. And there's like a 10 basis points window there. Maybe there's extra liquidity there as well. So I don't know how much extra liquidity and extra Q2 they want to do, but and I was thinking QT is going to end when that is drained, but they're not going to end QT in a month. They're going to stretch it out, taper it, reduce it, and we are already approaching that window, and it makes total sense, I think, that they're going to announce some sort of QT taper, not an end to QT, just a short, maybe one-off, maybe planned taper to the QT, so that the monthly QT will be less as the reverse repo facility gets low. And today it was like 620 billion, something like that. So I think when this starts panning out, obviously front end doesn't give a fuck about QT. The beneficiary is going to be the long end. The duration bonds are going to benefit from, and the real yields on the long end should come down.
I hope so.
So theoretically, at least, deficits are something that we have to worry about. And like I keep seeing headlines about deficits everywhere lately. Like, so baffling. Before 2020, there was 20 trillion of negative yielding debt. Deficit situation was not that much better. Everybody was cool with it. Now everybody is all of a sudden fretting about deficits.
It's since COVID. Everybody got worried about deficits since COVID, post-COVID.
Yeah,
I don't understand.
I think that's just an excuse not to be bullish bonds. Like people are afraid because bonds lost 50%. TLT was at 200, now it dropped 80. It's more than 50%. So people are afraid to be bullish bonds. But I think there's a lot of cash that wants duration yield, but they're just afraid because there's QT and there's deficit. So I think as QT is paired, I think that money is going to start flowing into duration bonds.
I certainly hope so. I got some back as well in TLT, same as you.
You bought again?
Yeah, small. I'm still holding a small position.
I saw that you were saying you were thinking about buying again.
Yeah, a small position.
This is like a 4-month plan. This is not like a today tomorrow thing, but as the taper gets underway, I think that should benefit duration pretty well. That's one part. Another part is end of this month we should get quarterly refunding announcement from the US Treasury again. So if anybody remembers last time when it happened on 1st of November or 30th of October, something like that, well, October and we changed to November, at some point there, we got the quarterly refunding announcement and the Treasury announced their issuance plans, and it was maybe 150 billion, smaller than people were expecting. That kickstarted rally across all asset classes. And right now, people are again afraid. Like every time I'm reading bond commentary, people are afraid that Yellen is going to stop front-heavy issuance and start duration issuance again. And people, that's why, are afraid of buying bonds before quarterly announcement, I think. So end of month, quarterly announcement, another big thing for bonds. If we get another front-heavy quarterly refunding announcement, I think we're going to get another leg higher in duration bonds. As we approach the March FOMC meeting and we get more talk about tapering QT, after the end of this month, I think it's going to start to happen.
It could very well be.
Yeah, that's all I have to say about that both.
There's a lot of things aligning definitely for bonds. That's why I'm watching them as well.
Yeah. I'm waiting. I'm already pretty balls deep into bonds, and I'm waiting to add for the end of the month. I want to see quarterly refunding announcement. I want to make sure that Yellen is still sticking to front-heavy issuance. I want to add duration after that. We're supposed to get buyback program, the long-awaited buyback program, which is supposed to provide liquidity to the long end part that has poor liquidity. So which has poor liquidity on the long end? 20-year.
20-year.
That has the
Yeah,
worst
definitely.
liquidity. So I'm expecting some front heavy issuance to rebuy the long end. So this currently there's like a weird kink in the curve. 10-year yields 399 right now. 20-year yields 432. 30-year yields 418. So by all rights, 20-year should be between 10-year and 30-year because the duration premium.
Yeah, we can check it out right here. Wait, let me.
Yeah. Look at the 30-year, 20-year, and 10-year.
So at a 30 years, the red one, orange is 20-year, and yellow is the 10-year. So 20 years way above the 30. 10 is here.
Yeah, and 20-year should be between those two.
Yes, it should be right here. It should be like 4.08.
So that becomes like a roughly 20 basis points extra.
Yeah, that is like 20 basis points, 50 basis points, yeah. It should be somewhat like 4.08, 4.09, right? Somewhere here.
Yeah, so there's
But
like
it's up there.
20, 25 extra basis points on the 20-year. So I think as the refunding and as the buyback program goes underway, if Yellen does what I expect her to do, the 20s are going to be the biggest beneficiaries. I think overall the long end itself is going to be beneficiary.
Yeah.
And 20-year most of all.
Yeah, you gotta say. I mean, if you just look at it from a logical perspective, and as markets should work, should function, the long end should not be here on the same level as the short end. That is number one. Right? So the long end should be way higher actually than the low end.
Yes.
Yeah, than the short end. So short end should go down quite a bit. Or in other hands, long end going up. But in this case, of course, short end going down as we approach the cutting cycle. So the long end should stick up here somewhat for the duration premium, but the short end should go down. I mean, all should go down, but the short end should go down quite a bit more, in my opinion, on the yields. But that doesn't change the fact that the 20-year should be between the 30 and the 10-year, of course. I mean, of course, risk premium should just be in between and not having the 30-year.
Yeah, I mean, it has been like that for quite some time.
Yeah, it has. It has.
It's like the weird kink on the 30s and 20s has been like that for quite some time.
Yeah, if we just close out, let me see. If we go here, US 20-year, and close out this one. Now we can just see it. So blue line is the 20-year, red line is the 30-year. Yeah. So you can see it's all the way back to, I don't know. The last time it was sort of same was back in late 21, right? And the first...
The 20-year had always had poor liquidity.
Yeah. Mid 21 is probably the last time it was sufficiently below the 30-year. So that is quite some time back, and it actually shouldn't be that way. So
yeah, but
definitely...
see, this is just like still a recent development, right?
Yeah.
And it should be fixed. And I think the buyback program is going to fix it. And I think there's extra 20 basis points to be had. Instead of buying 30-year, if you want duration bonds, I think one should definitely go 20-year to get that extra 20 basis points. And it's a bit better.
Yeah, I mean, why do you don't want to buy the highest yielding one, right? That is the first thing.
Yeah.
If you're buying duration, just buy the highest yielding one. I mean, that is... And if it's then not the longest one, of course, you go for the 20. I mean, that's a no-brainer, right?
Yeah, that I am not entirely certain this is going to happen, but, there is a lot of bonds issued after COVID at, like, really low yields.
Yeah.
So if Yellen is certain that we're returning to low-yield environment, which I'm not certain it's like she's certain about, but she could buy back the duration yields issued at, like, I don't know, 1.7%. They're probably down like 50, 60%.
Mm-hmm.
And simply destroy the yield and to front heavy, like, let's say, issue 1 trillion on the 2-year.
Yeah.
And buy back 1 trillion of the 2030 year issued in 2020 and destroy that 1 trillion, you're going to probably destroy like maybe 2 trillions of debt for 1 trillion of today's issuance on the front end. So I don't get why she doesn't do something like that if they're certain. I mean, I don't think they can speculate like that, but yeah, I am like maybe once she becomes more certain about the path forward, something like that will come forth.
That could be. That could be. I truly think they're just. I know what you mean there.
Yeah.
I'm inclined to say that they just don't want to speculate too much at that point. But eventually we're gonna come around to that point, and they may do something.
I mean, look, why wouldn't you do that? You would reduce the U.S. debt burden by a good amount if you do.
Yeah.
And you're gonna bring like better liquidity. Yeah, I think buyback program is in part going to be something like that. Like I think it's going to be net issuance on the front end to net buy on the long end. And I think like they're gonna have this new thing on their balance sheet with like front heavy and less back heavy from their historical issuance, and I think it's going to reduce the overall debt burden, like I described. I think buyback program is going to have an element like that, but I don't think it's going to be in any significant size. I don't think it's going to be like $1 trillion or something. It's just going to be probably small.
Yeah, we should see. I mean, if it's not
yeah, well,
too
we'll
big,
see. It's been like a long rumor. We don't know the full details yet, but I'm looking forward to it.
Yeah, I mean, we just started the year, so there's a lot of things to come still in 2024.
Maybe it will come with a refunding announcement. Like maybe the buyback program will be announced with a refunding announcement. I could not find any details about the timing. Like it should be first or second quarter. I don't know when. So I'm hopeful and watching the refunding announcement to maybe hear about the buyback program. And you know, bonds are slow money. So after the refunding announcement, if we get good information on both fronts, I'm gonna add to my position, which is already pretty heavy.
Yeah, I'm gonna do that as well. I'm definitely gonna buy some more TLT. Like as I said, I just closed out for the year end, which was actually a good call there. We touched 100, but that was
you closed out at the highs.
I just closed out at 100 because there's a flat level. I just want to get out of it into the year end because I thought we've just been a bit too fast for a bit. But we slowed down. We touched the monthly pivot, which is one point I was looking at. We also got very close to the new yearly pivot point, which is something I'm always looking at on the bigger picture as well. So I'm certainly more bullish again on TLT, and I bought a little
Let's quickly cover the auctions like this. I mean, after everything was said and done, 30-year auction stopped through with 0.1 basis points, which is makes me happy. It says to me that the yields are just right. Yields are okay.
Yeah, that was after CPI. To go too high. You gotta say that was after CPI as well, when yields just been
so it was like a clean auction without anything hanging on it. So it was like a clean supply and demand, and it was almost on the screws with like 0.1 basis point stop through, which tells me that's why probably the move index, the bond VIX, went down 5% today, which means we're not really expecting high volatility for bonds going forward because things are about just right for what we know right here.
Yeah, I truly like it. Like going forward, if you just look at TLT, if you put up some my favorite tool, some Fibonacci retracements there. If you put it that way,
still a long way to go.
Yeah, we got 23%. We touched the 23% level right at 100. The next level would be 111, and that is just a 38% Fibonacci, right? So if we just make up half of the move, we end up with 120, and that could come very well.
Wait. This doesn't seem right. TLT highs were close to 200.
No, I put it in 160, which was without the liquidity highs there. If you put it up there, it was 165 on tradingview.com. I don't have any idea. I don't see it on 200. 165 is the high there.
Yeah, okay, so 171 was August 2020.
Okay, I have it at one.
Maybe this one adjusts for. Maybe this one is adjusted for. What's that? Dividends? But no.
No, it should not be.
Okay.
I don't know.
Okay, TLT. Let me look at weekly chart. So yeah, 2020 was 171. Yeah, even without the spikes, we traded around that 170 quite a bit.
Okay. Then maybe something is wrong on trading view. I don't know. I just don't want to put up the chart on my trading platform, to be honest. But
Yeah.
even if it just took that, right, we still gotta go 120 or around 120 by 2024, end of 20 before the end of 2024. That is the forecast, at least
Yeah.
on my side. So that is more than 20% to gain.
Let's look at the
Probably,
yields. Like it's like yielding what 4.3 right now. If it goes to like I don't know 3, and I think 3 is a reasonable long-term yield, TLT should go to maybe like 130-ish, something there. 125, 130 should be close to that.
Wait, why is my chart not going back before 2020? Something is pretty strange here. Let me reload it. Still not loading. I don't know what's going on here. But anyway, we average go around 3% down there probably in 2024. But we gotta see. I'm definitely bullish TLT, definitely bullish bonds going forward. But same time, I'm bullish dollar as well, right? So don't mix it up. You can be bullish both.
Yeah, it's for dollar. It's about differential.
Yes. If we look at
everybody else is gonna cut more and faster.
Yeah. If we just look at the 2-year yields on the euro bonds, you know, those should come down substantially, like really hard. And that's why the euro, as an example, should fall really quite a bit. But
yeah,
we're gonna see. We're gonna have to wait for more data, for more Fed speak and central bank talk in the coming months. But whatever, we got quite a very interesting week behind us with the CPI reading on, of course. As the top-notch data, we got jobless claims that have been quite hot, QT taper talk maybe, and some solid auctions.
We're getting divergence between data again. There's lack of clarity about the state of the economy again. We have two things saying two different things.
Yeah, it's really just choppy around in the market. And we actually we didn't
end of
look
2022 and start of 2023.
We didn't look at the equities just yet for a week.
We're gonna get earnings.
Yeah,
starting tomorrow with bank earnings.
Yeah.
I mean the XLF. Look at XLF, the financials ETF. It's been going up.
Where should I look?
Straight line. XLF.
XLF. Oh, that was the wrong one. XLF ETF.
Yeah, look at that move since November.
Yeah, it's just
not been like dipping at all. So this is the financial sector, and they're gonna start reporting Friday. So by all rights, earnings should be fine.
Probably. Or this one is gonna tank. Who knows, right?
Yeah, I'm not sure banks are in a bad position. I think they're fine.
I don't think so either.
I'm not certain about tech stocks.
Yeah, that is one thing that is really getting into my head. I mean, if we look at NQ, it's just it's just straight up as well since probably October, November. It's just going up there. Probably not topping out too much.
Did a rather sizable move since then.
But there are some companies in there, which make me think we might see a top probably soon. Like if I'm looking at Tesla, I'm probably not too bullish.
I mean,
But
the basic expectation for me was things are gonna top out next week during the OPEX week of January, especially the expiration, which is Tuesday, 17th.
yeah,
That was my top window.
yeah,
So after that, the favorable flows of inflows into stocks should theoretically close, and if earnings, if there's a hint of weakness, should start hitting to the downside.
yeah. It would make sense as well if we look at if we just take the VIX as it is. We are due for some pullback. I mean, it doesn't have to be a big one, but we are due for a pullback in stocks and equities. VIX is down at 12.5 as of right now, or around that level.
Yeah, as it approaches 12, you always have to start getting, cautious.
Yes, a bit
12
cautious.
is way too low.
Yeah, way too low. And you also gotta say the high of the VIX was 14.5 over the last 2 months. Is that is just
Last
too low.
Entire quarter was a low volatility regime.
Yeah.
I mean, still we have the favorable flows going into stocks due to the turn of the year. And this is not my work. There's a Jim Croissant or something he's called. He does great work on option flows and general flows.
Okay.
He has been getting the right flows of the last rally. Like he was predicting weakness into the turn of the end of the quarter, end of October and start of November last time. And then he predicted the strength after that. So he's a celebrity now. You can hear his interviews everywhere because he got the last 2 big moves right. And his third call was end of strength at expiration January 17.
Mm-hmm.
After that, more downside on stocks.
Yeah, that could very well be.
He was expecting a blow off top.
That could very well be. I mean, especially if I'm looking at tech stocks, I'm getting a bit worried. Well, not worried at all, but a bit cautious for more upside. And we'll probably
before we get to any of that, we have Taiwan elections this Saturday.
Mm-hmm.
I mean, I'm not expecting anything, but there's a chance for a surprise, and there's a chance for a surprise reaction out of China. So it's something to watch in the immediate vicinity.
We also
we got through the CPI.
In the very short term, we also get China CPI, as we just said, tonight.
Yeah.
So that is something to watch as well. If that is coming in a bit higher than expected, in my opinion, probably
that's going to be a good thing, though.
Yeah. It's going to be a good thing. So we probably see stocks fly, China stocks. That would be something. And that is something I'm looking forward to. If we get a low inflation reading, is the PBOC gonna just gonna go out with the big bazooka and just cut rates a bit more aggressively?
Yeah.
That should actually jump stocks as well, right? So both ways, I see stocks up.
But stocks have been, down like maybe 5%. Wait, let me look.
What should we look at? HSI?
I'm looking at. Oh yeah, China is down roughly 5% across the board since the turn of the year, basically.
Which one?
MCHI. Yeah, whatever. Anyway, anything like I'm looking at like an average MCHI.
MCHI.
Yeah. So since the turn of the year, it's down roughly 5%.
Yeah.
And we have finally arrived at the election window.
Yeah, I was always looking at the HSI.
Yeah, I'm saying.
Yeah, that's down just quite a bit as well over the last couple of days.
Yeah.
But I can see it will really back up at least 17,000 right here. Maybe even
I think
18,000.
it should go to 18,000 if elections there's a surprise KMT win.
Yeah, somewhere
the
up
KMT
there.
party.
Somewhere up here will be my target as well in the short term. right into that one.
Yeah, but I don't really know much about Taiwanese political parties. I just know that the KMT is favored by CCP. So if it's KMT win, should be favorable for Chinese assets. Outside of that, we'll just have to watch.
Yeah. Yeah, we just gotta watch and we just gotta profit off it. Is there something you're gonna look forward to next week? Something special, or do you sense any
I'm
immediate move
actually
coming?
mostly I'm planning to actually close out trading entirely after the elections in China,
Okay.
as we're approaching the election season in Georgia. And I got work
Oh
to
yeah.
do.
Yeah, I see. I see.
Next week, let's look at the calendar. Monday, nothing. I don't really care about Canadian data. Um, there's 20-year auction next Wednesday.
Hmm.
Uh, initial dollars claims there's tips auctions. The next week seems just like some low tier data and auctions. Nothing really huge.
Okay, that's interesting. That's interesting because then we just gotta get flows again, which
Yeah,
is probably not a good thing for us intraday traders if we're trading just FX. Uh, so probably
yeah,
not a very boring week of 80 pips ranges up and down. Uh,
yeah,
horrible, but it is what it is. We gotta take it.
yeah. It is what it is.
So we're
But I
probably
think
coming
I'm
to an
getting
end here
sick.
for the day. We probably covered everything we wanted to cover.
Yeah,
Is there any question left from someone who's here? I gotta check who's here actually. It's just Kelvin.
I just Kelvin is here.
And yeah,
Yeah, we'll take that as a no.
we take that as a no. And then we're just gonna finish up our second episode of the podcast. Trying to put it online as soon as possible. And that said, have some fun, have some good night, and gonna see you next
Yeah,
time,
all right,
guys.
guys. See you next time. Bye bye.
All right, thanks, Talion.
Take care. Bye bye.
Yeah, bye.
I really hope you enjoyed this episode. If you did, give us a thumbs up, subscribe, and share it. Also, give us suggestions and feedback in the comments so we know what we can do better. And as always, trade carefully. See you next time.